Hi all, today we're looking at the determination of exchange rates. We'll start with a definition. Exchange rates are the price of a currency in terms of another currency. Anytime we talk about the value of a currency, it is always in relation to another currency. For example, the Australian dollar is most often reported in terms of its value in US dollars. That is, how many US dollars one Australian dollar can buy. This definition frequently comes up in Part A of Paper 2, and you should always gain the full 2 marks for it. Too often students neglect the last part, that is, terms of another currency. Don't be one of those students. Okay, we'll look at labeling the diagram. It's back to simple microeconomic demand and supply. In this example, we'll be talking about rupees, so we'll title it Market for Rupees. The x-axis remains as Q. The y-axis can be labelled different things. We're comparing rupees to US dollars here. So it can be price of rupees in US dollars, can be US dollars per rupee, or simply exchange rate. If you do not label this correctly in Part B or C in Paper 2, you cannot gain full marks. So you'll only be able to get 3 of the 4 marks, even if you do everything else right. I suggest that you get in the habit of using exchange rate for simplicity. You can use ER to indicate the price of the currency on the y-axis. In a freely floating exchange rate system, it is the equilibrium of demand and supply that determines the exchange rate. If the equilibrium price increases, it's known as appreciation. And if it decreases, it's known as depreciation. The terminology here is important. Make sure you use it. We'll now look at factors that affect the exchange rate. Demand for a country's exports will affect the exchange rate. When other countries buy Indian imports, they first have to buy rupees. An Indian company won't accept US dollars. They have to pay their staff, etc. in rupees. Therefore, an increase in exports means an increase in the demand for rupees, shifting D to D1, and therefore the exchange rate appreciates. Remember to use the terminology, from ER to ER1. Conversely, if Indian exports fall out of favour for whatever reason, it will lead to a decrease in demand for the exports, meaning a decrease in the demand for rupees from D to D2. And a depreciation in the exchange rate, ER to ER2. Simple. Another factor, domestic demand for imports. When Indians buy from overseas, they need to buy the currency of the foreign country, much like foreigners had to buy rupees to buy Indian products. They are selling rupees to do this, which increases the supply of rupees in the market. Therefore, if they buy more imports than previously, supply of rupees shifts to the right. So buying more imports, increase in supply. And the equilibrium price decreases from ER to ER1, thus there is depreciation in the value of the rupee. It will now take fewer US dollars to buy 1 rupee. If the Indians buy fewer imports than previously, they are now supplying fewer rupees. Decrease in supply and therefore appreciation in the currency. Next is relative interest rates. Holders of capital will invest where they can receive higher returns. The higher the interest rate in a country, the higher the return. If the Reserve Bank of India implement contractionary monetary policy, so increasing interest rates, more capital will flow there, seeking the higher return. Therefore, there's an increase in demand for the rupees. People buy rupees to deposit in the financial institutions in India. If the Bank of England, however, increases its interest rates, the capital held in Indian financial institutions will move. They will move over to Britain to gain the British rate of return. Therefore, rupees will be sold, shifting supply to the right and causing a depreciation of the rupee. Next is relative inflation rates. If the inflation rate of India increases relative to its trading partners, their exports are now more expensive to buy, meaning that fuel will be bought. We learned earlier that a change in the amount of exports will affect the exchange rate. And here we see a decrease in demand for the rupee as a result. Therefore, a depreciation. But we're not done on this. If India's local products are more expensive, Indians have a greater incentive to import because they can get things cheaper. As we've seen previously, if they import more, they are increasing the supply of rupees, S to S1, shifting the curve to the right. Both of these lead to a depreciation of the rupee. Next is foreign investment in firms. Investment in companies can be foreign direct investment or portfolio investment. You'll learn about these a bit more later in the course. The effect on the exchange rate is quite simple. An increase in investment in Indian firms will mean that more rupees are demanded by the investors. So there's money coming from overseas invested in Indian firms. So they have to buy the rupees to invest. If the foreigners, so this will increase demand, therefore appreciation. If the foreigners, however, sell these investments in order to invest in other countries, they will be selling rupees and therefore shifting supply to the right and leading to a depreciation of the rupee. Final one to look at is speculation, which is actually quite big. There is a huge amount of buying and selling of currencies by investors looking to make profit just on the buying and selling of the currency. They are speculating on the appreciation or depreciation of currency to make profits. The Australian dollar, for example, is actually one of the world's most traded currencies, despite it being far from the largest economy. It's all based on the future expectations. Back to India. If speculators think that the rupee will appreciate, they'll buy now and hope to sell it later at a profit. Makes sense? If they think that the rupee will depreciate, they will sell now, increasing supply, and then hope to buy it back later at the cheaper price. You can see that a belief that the currency will change can actually be a self-fulfilling prophecy. Okay, the key here with exchange rates is to understand whether the event will impact demand or supply of the currency. Ensure you understand the different factors that can affect the exchange rate. Thank you.